I like to just start with what I need. So I'm looking for KE. That's what the question's saying. It's saying determine and fully justify your beta and then determine the KE. So KE we know is the risk-free rate plus beta times the market risk premium or equity risk premium. So KE equals, and so we can see that the risk-free rate, we're going to use the 10-year treasury if it doesn't say anything else, and even says that they use the 10-year. So that's 3.5%. As I mentioned in class, anytime you have percents, always just put it in the decimals. Some students really mess up. It's been a bigger issue for graduate students and undergraduate, forgetting that 3.5% is 0.035, but some students get nervous, so be real careful. Plus beta times the market risk premium. So let's get the market risk premium. Market risk premium is going to equal, we're using an implied approach, so the expected return on stocks minus the risk-free rate. The expected return on stocks is going to equal dividend yield plus maybe buyback. Is someone catching me saying something? Yield plus expected earnings growth. So we can go get those numbers. So let's go look at it. The current dividend yield for stocks, 1.6%. And so we don't care that Hormel's dividend is completely a red herring. You don't need that. So that's 0.016 plus. She does use the buyback yield and she uses 1%. So if she says she uses it, then put it in there. Plus in corporate earnings growth of 5.5. She gave you all this stuff up here, but you don't need it. That adds up to 5.5, but you don't need it because she says it right there. So that's kind of a throw you off as well. When you do all of that, you should get 8.1%. So does that look like 2.6 plus 5.5, 8.1? So 8.1 is expected return on stocks. So 0.081 minus 0.5 gives you a market risk premium 4.6%. So we can plug that in. Any questions up to there? Y'all interrupt me. I'm not good at chat. So if anybody's doing chat, I'm not going to see it. All right. So for the beta, I'm not looking for a paper or a dissertation, but do need to do the 4 steps. So Hormel is definitely a consumer staple, defensive company, so low beta. I mean, that's what I'm looking for. Is it defensive or not? So we're talking a food product and a pretty cheap one. Chili's a pretty cheap way to get protein, pretty inexpensive. So something people will probably not cut back on in a recession, may even buy more of. You don't have to have a whole discussion, but at least tell me if it's defensive or cyclical. Second thing is we're going to look at is the operating leverage. I don't know much about Hormel, but let's look at their net margin, standard deviation. And remember, this is not their net margin. This is the standard deviation of the net margin. So don't tell me Hormel's margin is 2.13%. This is the standard deviation. So I would say the very low relative standard deviation of net margin, 2.13% versus, I have to go back and find the numbers, 7.4. Implies very low operating margin. operating leverage, excuse me. So more evidence of a low. All right. I don't know if someone's trying to catch me or not, but let's see if I can. All right. The third one, the easiest one of all, is financial leverage. Going down, look here, their financial leverage is a little bit below average. Debt to equity is slightly below typical stock, so no impact on beta. So what do you do with this? Debt, high debt. If you're going to use a 0.5 beta, it might go up to 0.6, 0.7. They have really, really low debt. If you're going to use a 0.8, it might kick you down to 0.7. It's not going to radically change. You're not going to go from 0.5 to 1.5. If you're in the ballpark between, say, 0.5, 0.6, 0.4, 0.6, I'm not going to give you a definitive number, but you're within the pack of the middle of the market. It's really deceptive what I'm telling you here, because this is something that is absolutely industry specific, and we're not getting into that. You really can't compare the debt of a tech company to the debt of a utility. And so that's just, we're violating some rules here, but for our purposes, just to get some practice, we're just going to look at them versus the entire market. And then the last thing is their history. We look at their history, their median's been a little bit below 0.5. They were higher much longer ago. That may be because they were a smaller company. They've been pretty consistently between 0.2 and 0.6 the last few years. I feel uncomfortable going below 0.5, but if you could certainly justify 0.4 here. So given above, I recommend 0.5 or whatever you use. So if you use 0.5, 0.4, 0.6, that's fine. How do you get something wrong here? It's if you're like use 1.6 or something, which just doesn't make sense with everything we just said here. So you put all that together and you should get a discount rate of 5.8%. Depends on your beta, so every student will have a different number to be sure, but should be somewhere in that 5 to 6% range. I can't imagine, anyone's going to use a 0.7, 0.2 maybe, but I think 0.2 is probably too much. And that's what we're looking for here. You're looking for that answer, and then I'm looking for all 4 steps. So you do have to do the 4 steps. If you leave out the steps, be off. All right, I'm going to move on unless you have questions, so y'all have to interrupt me. Second question, I give you the discount rate. And since I give you a discount rate, this should be an easy problem. In fact, most of the class, probably 80% of class gets 100% on this one, because this is just plugging numbers into a formula. So the dividend discount model, value is going to equal dividend 0 times 1 plus the long-term growth divided by KE minus long-term growth. Very, very straightforward. So here, the dividends is $1.10. Long-term growth is 5%. All of that divided by 6% minus 5%. And you should get 115.50. H model, exact same thing again. Dividend 0 times 1 plus long-term growth divided by KE minus long-term growth, except we're going to add this middle section in here for the higher growth period. So plus dividend 0 times the H. So Continue expansion in emerging markets. They expect earnings to be 12%. That's going to be your short-term growth. Moving back to long-term over 6 years. So your H is half of whatever that number is. So you're going to multiply it by 3 times, I'm sorry. So dividend 0 times, let's use the typos, 0 times H times short-term growth minus long-term growth. So the same formula, but you just add in this middle section. I always, it's frustrating to me that students say, do we have to memorize these formulas? It's like, wow, this is a really simple formula. It's pretty easy to learn. So no, don't memorize anything. You should just know these formulas. These are pretty basic financial formulas, especially the dividend discount model. Every finance student should know that backwards and forwards. So here we got dividend 0, 1.1 times 1 plus 0.05 plus 1.1 times 3 times 0.01.12, sorry, minus 0.05 divided by 0.06 minus 0.05. When you do that, you should get 138.60. All right.
Sorry,
Hopefully that.
Professor. Can you show again where you got the H from again? How you got the H?
So the H is how long does it take? It's half of how long it takes them to get from 12% growth to 5%. So 12 is your short-term growth, and then how long does it take? They start off at 12, and they're over the next 6 years, they're going to drop down to 5%. So your H is your half-life, and that's going to equal that 6 divided by 2 equals 3. So if it takes 6 years, my keyboard has it's very sticky keys. If it takes 6 years, then your H is 3. Is that good?
Yeah, thank you.
All right, and then the bond valuation. So this one's a little bit more involved, but this is something you should have known coming into the class, so it shouldn't be an issue. You should already have known how to do this, but just this is a refresher. Plus, I'm a little bit picky on I want you to do the entire table. I don't want you to memorize calculators in Excel. Calculators in Excel are fine when you're doing it, at work and you just need the number, but I want your mind to know what is that formula doing? What is your Excel doing? So here what we need is the cost of debt. Cost of debt is going to equal the risk-free rate plus the spread. So it's a 10-year bond issued 8 years ago. So it's a 2-year bond. So the risk-free rate is going to be 4.3% because it's a 2-year bond. Given that it's a 2-year bond, it was rated AA 8 years ago, but that doesn't matter. Today it's 8 plus. So we're going to use a spread of 115. So we add 115, but that's some basis points. So you have to divide by 10,000. And that's going to give you 0.0 545. You also need the effective yield, which is going to equal 1 plus KD divided by 2 raised to the second minus 1. Why? Because bonds pay twice a year, and that's going to give you 0.0552. And then we have to build a table.
Excuse me, Professor.
Uh-huh.
It is I know yeah, so it pays twice a year, but then also there's 2 years left. So just for clarity, the denominator is the number of payments, correct? And then the raised number two is it equates to like the 2 years that's left on this particular bond, correct?
The 2 and the 2 are the exact same thing. It's twice a year. Has
Okay.
nothing to do with how many years. If it
Okay,
paid
thank you.
monthly, what would you do? You divide by 12 and raise it to the
12.
12th. If it
Yes,
paid
sir.
quarterly, you divide by 4 and raise it to the 4th. It's the
Oh,
exact same
gotcha.
number. All we're doing is we're saying, hey, let's take this rate and let's compound it one extra time in a year. That's all we were doing here. All right. All right, so we got to do the table. If you want to do, your calculator will give it to you with the PV function. You know, there's ways to test it. I gave you the ridiculously long formula, but with the table, you've got time. Let's see if I can put a table in here. So we need time, cash flow, discount factor, and discounted cash flow. So that's 4. And then we need the total, and we got 4 years. I mean, 4 periods, 2 years, but 4 periods. So we'll do 5. So we've got time, cash flow, discount factor, and discounted cash flow. Yeah, I do wish we could do this exam in Excel. It'd be a lot more interesting. I'd probably give you a 20-year bond or something. But sorry. All right, so when we do this, rounding is going to be an issue when you do this. And so you want to make, you know, if you do it in your calculator and test it again, just realize you can get different answers. I'm going to see my answer key is not rounded, so I might do it rounded as well, just to make sure how big different it is. You shouldn't be off by a few pennies. So we'll get a cash flow in 6 months or half a year. We'll get a cash flow in a year and a half, and in 2 years. Our cash flow is going to be the coupon, 6.5%, but it's twice a year. So the coupon is going to equal $1,000, and always use $1,000 times 0.065 divided by 2. That's going to equal 3250. So that's going to be our cash flow. Except for the last year, we'll get our $1,000 back plus our 3250. All right, so now we got all our cash flows, which is pretty important. Our discount factor is going to be 1 divided by 1 plus the effective yield raised the time. So here it's going to be 1 divided by 1.0552 raised to the 0.5. And I get 0.9735. That's using a rounded 552, so that should be good. I did actually round this to the nearest. So that one should be the number you get if you're using the rounded numbers. And then I get here you raise it to the first power. And so there I get 0.9476, 0.9225, and 0.8980. And here you just multiply across. So 3250 times 0.9735, and you're going to get 31.64, 30.80, 29.98, 927.23. You look and say, okay, my discount rate is 545, but my coupon's 650. So this looks like a really good bond. It's paying me 6.5%, and the best I can get is 545. So it should be a premium bond. You know that it's going to be greater than $1,000. So we add these together, 3164 plus 3080 plus 2998 plus 927.23. And I get 1,019.64. It looks like it's actually 65, but that's just the rounding going on. So if I get rid of the rounding, it probably would come out to 65. So don't worry about the rounding. Should be within a penny. I don't think it can be off more. And that's the reason the accountants do this as well. You go out 4 decimal places, you're unlikely to have serious rounding issues. All right. So I need to see the table. This is not a plug it into your calculator, not Bill Gates do all the work. I want to know that you know what a discounted cash flow for a bond looks like, that you can picture what your calculator is doing. I think a large number of students just assume it's some kind of magic that's going on, but all your calculator is doing is exactly what we just did here. Right?
Professor, I have a quick question.
Okay.
Um, is there a specific amount of decimal places you would like us to round to? Because for my answer, I ended up with 72 cents instead of 0.64 cents.
72 seems high, but I would go out 4 decimal places here. Let me try it with the rounding. I'll do it real quick and just see if it makes a big difference. Because that seems a little much, but I mean it's probably fine. Let's see. That actually brought it down. Let me try one more rounding because I'm not getting your number.
Because I used 6 decimal places for the discount factor instead of 4.
Even in doing it by hand.
Yes.
Oh, okay. I can't get 72, so I don't know what. I mean, you might have a slight typo somewhere in your numbers. That could be it. If you're within, I mean, 2 cents, you're not going to know, right? Because if you have a slight typo, that's why if you show me everything and I see your typo, I won't count off on it because obviously this is a lot of number crunching. I'm not trying to see how perfect you are typing into a calculator. So if you have it all set up and maybe it's off because maybe you switch the 2 and the 5 on something, that won't cost you any points. But I don't know if anyone else is getting 72 cents, but no, I'm getting, if I round everything, I'm getting 65 cents. So it should be within a penny, but being off 7 cents, there's something probably going on somewhere. It might have to do also, I don't know how far out you went on the 552. You went out 6 there. Let's see if I can get that. That can have an impact.
No, I got 5.52%. I got the same thing for the effective yield.
Yeah, I wouldn't worry about it. It seems like
Okay.
it's close enough. I mean, you understand all the math, right? You're doing all the calculations.
Yes.
So
Okay.
that's the key. So round or even slight typos, it's not a big deal,
Okay, thank you.
right? So let's run to the next one. So here we have 4 things we need. We need the holding period returns. And then we're going to do some averages and we're going to annualize them. We need 5 things, averages and then annualize them. So it's not going to let me. So, so the holding period return is going to equal ending market value minus beginning market value plus income divided by beginning market value. So we'll start with September. We have September, we have 45.44 minus 50.28. And the X date, just look at it now, the X date is 10/14. So we're gonna put the 26 cents in October. So no income in September divided by 50.28. And that will get you a really bad number, 0.09, negative 963. October, you will have 46.45 minus 45.44. Here we add the income in, 26 cents divided by 45.44. When you do that, you get 279. And then November, you get 47 minus 46.45, no income, divided by 46.45, and you should get 0.118. So there's question one. Y'all stop me if there's any questions. The second one is arithmetic. And on there, you just add them together. Minus 0.0963 plus 0.0279 plus 0.0118. It's 3 months, so you just divide by 3. And you should get an arithmetic average of minus 0.0188. Annualized equals, and you put that little asterisk on the annualized, equals minus 0.011188 times it's monthly, so times 12, that equals minus 0.2259. Our asterisk says CFA Institute does not allow periods of less than a year to be annualized. Right, and then we'll do geometric, which is the difficult one. So here we have to put every period together. So you have to do the first period minus 0.1 minus 963 times the next period, $1 times 0.0279 times the next period, 1 plus 0.0118. And here we're not going to divide by 3. Instead, we're going to raise it to the 1 divided by 3 and then subtract 1. And we know we have to get a lower number. It has to be lower than negative 0.0188. And the number you get is negative 0.0204. And then annualize, what I'd recommend is that when you're doing your calculations, write this number down. Write this number down so that you have it, because you're going to need it again. It's the exact same formula, except for we're not going to use 1/3 because we're annualizing. Use 12/3. If this was 37 months, you'd be raising it to the 12 divided by 37. So the bottom number is the number of months. The top is how many months in a year. That's always the same. So it's always going to be 12 when you annualize it. The bottom depends on how many holding periods you have. This one can be higher or lower than the geometric. I mean, the arithmetic, it doesn't really matter. In this case, it's actually higher. But that's not really, that's key. And the annualize here, same thing. That's where the asterisk goes. All right. So that's all of 5 of the numbers we're looking for. All right. Any questions on there?
Yes, sir. Professor, you have 1 times 0.0279. Should that be 1 plus?
Yeah, 1 plus. Thanks. Yeah,
Okay.
I did that if anybody was paying attention. So good. I knew Camille would save me there. All right. Anything else? Now, on the exam, you should write it all out just like that. This is a place where it's really easy to make a math error. I don't count out for math errors, but if you don't write it out and you get the wrong answer, I can't give you any partial credit. You could have negative 0.027 or something, and I can't give you, I don't know how you got that number, so write everything out. That's not that much to write, but write it all out. All right, problem 5 is, so here, you want to have a comment next to each one of these. All right. So let's just go through and look at these ratios. We're asking which is appropriate. So we'll say ratio is fine, and then we'll add the rest. EV to cell ratio is fine. We'll add the rest. Here, we're going to say ratio is flawed because EV is stock and bond holders, while book value is only stockholders. So EV, the book value doesn't make sense. You would never use that. So you don't have to say if it's appropriate for Hormel because it's a bad ratio. So that's all you have to say there. EV EBIT is fine. Ratio is fine. So the question is, does it make sense? So is this a consumer staple, a retail stocks? So ratio is fine on price to earnings and works for all industries, but there is one better for HRL. There's a more appropriate one, but yeah, we can use, everybody uses price to earnings, no question. Enterprise to sales ratio is fine and is best for HRL or a retailer focused on margins. So I'm not looking for a dissertation, but you do need to give me some explanation. And then enterprise ratio is fine, but generally used more for growth focused industries like tech, something like that, right? So make sure you have something to say on each one of them. You have on all of them, you're going to say whether the ratios are fine or not. If the ratio is not fine, that's all you got to say. You don't have to say anything else. If the ratio is fine, then you got to talk about, is it good for this company? So remember, if it's tech, high growth, so I'd probably include, communication services in there. EV to EBIT or EV to EBITDA works really well. If it's retail, pretty obvious, it's going to be EV to sales. And then you got all the rest of them, manufacturing, commodity driven, and financials. And I'm not going to give you financials. Price to book is the most common. Yeah, commodity driven, like energy companies, steel companies, concrete companies, those that are very sensitive to the price of some commodity. Manufacturing that have a huge property, plant, and equipment. So I'll look for a hint here. I even told you, look at that, with a heavy focus on margins. So I somewhat gave it away. Anybody focused on margins, you're going to use EV to sales. All right, so this isn't part of your answer down here. This is just a reminder of how we do that. So this is all the stuff in the yellow here. That should be part of your answer. So make sure you write something very clearly. For 3 of them, you have 2 things to say. Is the ratio good? And is this the best for Hormel? On the one bad one, you don't use that at all. You don't have to talk about Hormel at all. You just have to talk about the ratio. All right. Any questions on that one?
Yeah, I had a quick question. Isn't price to earnings best for the tech high growth, or is it for all of them?
Yeah, you could include price to earnings, but I'll just tell you, in practice, tech people, they're overwhelmingly EV to EBITDA.
Okay.
So you could say price to earnings is fine, works for all industries, and is particularly good for tech companies. But we just know EV to EBIT or EV to EBITDA, especially EV to EBITDA. It's just overwhelmingly their favorite one. And PEG ratios. I won't give you a PEG ratio. PEG ratios are pretty popular with tech companies. So it wouldn't be wrong, but all right. Any other questions? This is one to think about. I will say this is the worst question on the exam by far. It's probably averages 25, 30 points lower than the grades on all the other questions for some reason. I don't understand why. Must be the really bad professor explaining things, but yeah, for some reason it's just not sinking in. So, let it sink in. This is pretty basic stuff that you would want to know, especially if you get into an interview. This is like if you interview on the investment side, they just think this way. So they just assume everybody knows this. So if you struggle with this, you've got a problem with something that the people you're interviewing with, like, well, that's pretty obvious. How can you not know that? It's kind of the problem of interviewing where you're just so used to this stuff. All right, last question. Last question. Classes are getting better and better on A and B. And then C is usually the disaster, and D is getting to be about 50%. So I'm almost 80, 90% on A and B. C is probably 25, 30% to get it right, and D is probably 50%. So we got a call option, so we know the gain. Well, let's start. Well, we'll do the gain. So the gain's going to be the max of S minus X and 0 minus the call premium. So that's going to equal max of, so let's look at it. It's trading at $52 at expiration. 52. Our strike has a strike price of 45. So that's good. We got $7 gain there, but how much we have to spend to get it? So on the call option, we're talking about buying it. So we use the higher number, the S, 510 minus 510. And that will give us a gain of $1.90. But almost exactly the same thing. The gain is going to equal, but strike minus stock minus the put premium. And that's going to equal max. Oh, I left out max. I kept telling y'all don't forget max, but I forgot it there. All right, so here the strike has a strike price of 46. And it's trading at 45. So that's kind of nice, but that's only $1. How much we have to pay for this? Again, the ask price, $2.15. So we had to pay $2.15. So we're going to end up losing $1.15. Now be careful here. If I were you, I would probably add the word gain, 15, comma, $1.15 loss. The only reason I say that, a few students do the dash, and I can't tell if the dash is a minus sign or a dash is like a bullet. Say, here's my answer. So you might want to repeat it and say a loss of $1.15, minus 115 or a loss of 115, just to make it clear, or just be careful when you write it down. Sometimes you're in an exam, you're just going fast, and you don't realize, wow, I can't tell if that's a bullet or if that's an actual gain or loss. All right, this next one's a protected put. So protected put, you are long the stock and long a put. And so here the stock gain is going to equal the stock price of $35. That looks pretty bad. Minus, what did you buy it at? Well, the original price was 48. Minus 48. That equals a loss of 13. And then the put, you just do it again. Max of strike minus stock and 0 minus the premium. That equals max. Here our strike was 46. And here the put really helps us, 35. So it gets $11 of our money back. And we had to pay $2.15. So the put, boy, I don't even know what the actual put value is. I'll have to calculate that real quickly. But essentially you've got a gain of 11, but you had to pay $2.15 to get it. So you make $8.85 on that. So when you bring that together, you should end up with, so this is 8.85 gain. So the protective put going to equal minus 13 plus 8.85. And that's going to give you a loss of 415. loss. Pretty straightforward. If you remember what protected put is, what else could you have? We just did this yesterday, right? This seems you could have a covered call, long stock, and short a call. And so make sure you use the bid and not the ask. You could have a caller, long stock, long put, short call. Again, use the bid. You could have a straddle or strangle. Here your long put and long call. The only thing we're adding here is if you own the stock, you got to calculate that gain. That's pretty straightforward. Ending price minus what the original price was. Other than that, everything's. And so the only thing to remember, if you're short the call, there's two of them that are short the call. If you're short the call, make sure you use the bid. But then when you use the bid, your formula looks exactly the same as we did up here. The exact same formula. But then when you finish the formula, you just put a negative sign in front of it and you change it from a gain to a loss. So you're going to use a different premium because it's the bid instead of the ask, but you do the formula, the whole formula. Make sure you don't put the negative sign just on the intrinsic value and then not on do the entire formula, just like you normally do, and then you just put a negative sign in front of it. So that's the only really tricky thing on these with the short call. Make sure you use the bid and then make sure you use the exact same formula all the way through, and then at the end put a negative sign in front of it. All right, and then the last one is intrinsic value, or in time value, excuse me. So time value equals the option premium minus the intrinsic value. The intrinsic value equals, here we're talking about a call, is what we've been using over and over again. So you don't need anything new here. It's going to equal the max S minus X comma 0. That's the intrinsic value. Don't subtract the option premium, right? The intrinsic value is the first part of this formula. This is the intrinsic value. When you put the call premium in, that gives you your gain or loss. The intrinsic value on a put. So time value is the option premium minus the intrinsic value. And so here our intrinsic value is max of, so the call in this first question had a strike of 45 when the stock was worth 48. So it's in the money. So 48 minus 45 and 0, that equals 3. So the time value, well, let's do it up here. Time value then is going to equal the option premium, the call option in A. So the call option in A, we're talking about a loan call option. So we're going to be using the ask 215. Wow, I did something wrong. What did I do wrong? Oh, that's the put. Excuse me. All right. 510. Say, wow, we just violated the basic rule of option pricing. So 510 minus 3. Next up, time value of $2.10. And I'll put this out there on Canvas as well. All right, that's it. It took me 45 minutes with a lot of talking, so you shouldn't be a long exam. Questions?
Yeah, Professor, not really about the exam, but so because you're doing it online, you're able to kind of arrow down and create your own space. Are you going to give us enough paper so we can,
Yeah, you'll have the
format
regular
it?
just blank. You'll just have blank paper, so you'll just write it on the blank paper.
Got it.
Just put
Yep.
the
Okay.
yeah.
Thank
There's
you.
no problem. I got plenty of extra paper.
Professor, you're gonna upload this to YouTube as well, right?
Yeah, as soon as they send it to me, I'll probably have it out there today.
Okay, all right, thank you.
Other questions?
I had a quick question about the covered call. I want to make sure I have this right. So I have the minus sign in front of the formula, but then you would add the call premium, correct? Or is that
Well,
wrong?
the way I do it is for the call. I just figure out what is the call gain. The call gain is going to be max strike minus X comma 0 minus the bid
Okay.
price. I do that and I get a number. And then because I'm short, I just take minus that number. So I do the entire formula just like I did before. The only difference is I use the bid instead of the ask. I get that number, I get the answer, and then I take that entire thing. Now you could say it's minus that plus that. That would be true. You could do that.
Okay.
That's a new formula. So I'm suggesting just keep the exact same formula, but just put the bid in there, get that number, and then just change it on opposite side. If you get a negative number, make it a positive number. If you get a positive number, make it a negative number.
Okay.
But
Thank
you could do it your approach. That's true as well. Anything else? All right. I'll see y'all on Monday, I
Professor,
guess.
Professor
Uh-huh.
Sweet, can you go back to that same section that you just was going over that with someone, right? So just for my own self, so when you say like I'm getting the long call and the long stop a little bit confused. So I understand what the long call is using the max S minus X. I understand all of that, but when it says long stock, that's when we do like what you put up there, the stock gain 35 minus 48.
Yeah,
Is
it's
that
the assumption is you bought the stock at 48, and then the problem tells you what it's worth today. So it's now worth 35. So you must have lost $13. So
okay?
you're long the stock. None of these are short the stock. And I'm not
Mm.
really sure if there are common option strategies that are short the stock. So that's always
So
the same formula. It's the ending value minus beginning value.
right, but what I'm saying is, so in the protective put, when you the first part that you did was the long stock, that was that stock gain, that was the 35 minus the 48, and then you did the long put, which was the max. You did that. So if it was like in the covered call, you would do the same thing for the first part. You would do the stock gain, and then
Right.
you would do the short call because you're gonna short the call, so you're just gonna use the bid, right? So if it says
you-
long stock, but like in the straddle, you're gonna do the long put and the long call, which means you're gonna use those two equations, the max for the put
Right.
and
If
then the
we done a
max.
straddle up here, I mean, I don't know if this would have worked as a straddle, but I mean, essentially you got $1.90 minus $1.15.
Yes.
If this could have been a straddle, it probably doesn't because I think the expirations are different, but I mean, the closing prices are different, but
So then, yeah, so if that was the case, it would have been 190 minus 115, and then whatever that answer is would have been your loss or gain.
yeah, making it clear, whatever you get on this part, make sure you know that, stock's easy, whatever that ending price is minus what that first number is. And then everything else is what you've already done. There's no difference other than you might have to substitute the bid for the ask on the call option and then change the sign of that answer, but you're using the same formulas over and over and over again.